Hello, everyone, and welcome to our today's webinar. My name is Guillermo Sanchez, and today I will be discussing about the fundamentals of online trading. I hope you're all having a good day. It has been a lovely day here in London, sunny and warm. So yeah, hope you two are having a good day as well. So now let's start off with a little bit what I will be discussing about today. The first thing is what we'll be explaining to you a little bit what is contract for differences, or also known as a CFDs. And then the next point will be how do CFDs work, and also I will be giving you an example how it works and so for better understanding. The next point I will be discussing about is what is leverage and margin. And the next one is, what are the advantages and disadvantages of CFDs? Then the second part of this webinar will be discussing and explaining to you what is Forex trading and also how to trade currency pairs. And lastly, I will be telling you a little bit more about the type of orders that you can use for, when you are planning your trading strategies and so on. So what is a contract for difference? Well, essentially, it is an agreement between the exchange price of an asset when a contract is open and when a contract is closed. This will in turn help you to speculate on the price movements of financial markets without actually owning the underlying asset. And here, guys, you should be aware of this as well, okay? So when you're gonna be trading with CFDs, you don't own the underlying asset, okay? So let's say you believe that the price of, let's say, gold will go up, you just simply buy, okay? If you believe that the price of gold will go down, you simply sell, okay? That's essentially what it is when you're trading with CFDs. Well, they also are derivative products. So as I mentioned, explained to you just now, their prices are dependent upon the underlying asset to which they are linked. Also, you can trade CFDs on a variety of products, such as Forex, commodities, metals, indices, and also equities around the world. And well, also one thing I do want to mention, guys, is here with some trading terminology. Usually when you are buying, you usually say long. When you're selling, you usually say short. You will hear me saying this a lot. So yeah, so just please bear in mind when I say long, I mean buying, and when I say short, I mean selling, okay? So how do CFDs actually work? Well, they simply allow you to open a position with a small percentage in capital paid on front in form of a deposit, okay? Usually, well, this is what we call leverage as well. So CFDs are a leverage product. And simply the way it works is that you only have to put a small percentage of the full amount. So let me here give you an example. So as we can see here with the US 30 or the Dow Jones, we can see here on the right, the price of Dow Jones at the moment is, well, as the graphic shows, is just over $31,000. And if instead of putting that full amount to open that particular position, all you have to is put a small percentage. So in this case, it could be 5% or could be also 10%, 20%. That will depend on the leverage that you have in your account. And I will come to you in a minute what leverage is. So we can see here in this example, the full price of the Dow Jones is just over $31,000. But if you would like to open one position of the Dow Jones, all you have to do is put, let's say in this case, 5%. So that would be $1,566, okay, for that particular position. So this is essentially how CFDs work. And then now let me explain to you what leverage is. So essentially, well, it enables you to increase your buying power of a particular position by, well, simply depositing a small amount. Usually leverage is expressed in ratio. So you will see a lot 30 to 1, 400 to 1, 100 to 1, and so on. So this is how usually it's expressed. And also margin is what the minimum amount in capital required to open a position, usually expressed in percentage. So you will see a lot the margin is 3, for example, if the leverage for in your account for that particular product is 30 to 1, and then the margin will be 3.33%. So you can see they're similar, not the same, but they're very similar. And the relationship between them, and it's something I will explain to you here in the next slides, is you can see, well, you would like to calculate leverage. This is the formula. It's very simple. Obviously, once you know what your margin is. So as I said before, if your margin 3 is about 33% and you do the calculation, your leverage would be 30 to 1. And then also, you know your leverage, you can also calculate your margin. And as you can see, leverage has an inverse relationship to margin, okay? So that's, they're very similar products, similar, is that? Okay. So yeah, so I was saying they're very similar. It's also very fundamental to you to understand this, because this basically is the basic of CFDs as well. Also later on, I will give you a small tip on how to quickly calculate your margin once you know your leverage, which you should do anyway. Once, if you haven't had trading account yet, usually when you open your trading account, your broker will let you know what the leverage is. It will also be depend on where your account is held, whether it's in, for example, here in the UK, if it's under the FCA regulation. Also, you have a different type of leverage if, for example, your account is held, let's say, in Dubai under the DFSA regulation. Okay, so it's very important to know this. Since well, it's pretty much part of the basic of CFDs trading, and also for your understanding, once you place your position in the market, you should know how much money you need to deposit to open the position, right? Now, what are the advantages of CFDs? One of the main advantages of CFDs is that it give you a higher leverage, which can help you to maximize your profits, since, well, any profit is basically based on the full size of the contract. Also, well, it gives you access to the major financial markets. So as I mentioned before, you can trade Forex, you can also trade commodities, stocks, as well as indices and metals. And also another advantage of CFDs is that the contracts do not have an expiration date, unlike futures and options, for example, or even here you are based in the UK to spread betting. So you can hold your position as long as you would like, okay? So that is pretty much the advantages of DSCs. And the disadvantages, is a high risk product. And this is something that you have to be careful if you never traded CFDs before, okay? Simply because you can lose more money than what you deposit in a way that obviously would depends down to the volatility in the market and what type of position you were, how big the position was, but you can be in a situation where your account balance would be negative, and well, obviously that is a situation you don't want to be in. Again, obviously depends of the regulation where your account is going to be held, which broker you have your account with, and there's different regulation, different client protection in this regard. But overall, the platform usually has something that what is called stop out levels, which trying to avoid to come into that situation. But again, you have to be careful with it, because in theory, yes, you can lose more money with that what you actually deposit, okay? And here's an example. I want to give you an example why you actually could lose more money than what you actually deposited. So here's with the previous example I just gave you with the Dow Jones. Let's say, for example, you go to your bank and you want to open a trading account with them, what we call the cash markets. Once you set up your account with your bank, and then you ask them, okay, I want to trade the Dow Jones, and in this case, the price, as you can see, is just over $31,000. That is basically the amount that you have to put to trade that position. Obviously, like I already mentioned to you, with CFDs, you only have to put a small percentage of that full amount. So now let's say you, with the previous example, with the 5%, if now the markets, the Dow Jones go, let's say, down by 3,000, and let's say $3,133. Obviously, if you were in the cash market, you only lost about 10%, right? So you only have that 10% lost. However, with CFDs, and as I mentioned with the previous example, with the 5%, that you only have to deposit $1,466. If the market goes by over 3,000, like I just mentioned to you, obviously your account will end up in negative balance. So yeah, you always have to put that extra money to go back to zero. And that's basically the major risk of CFDs trading, okay? Okay, so bear with me 1 second. Okay, perfect. So now we go with the more interest stuff. That was basically just a basic of CFD trading and how they work. Now we come to the more interesting part, which is what is Forex trading and how to trade them. So you probably heard a lot about this in the media, in the news in the past, obviously few months, and also before as well. So basically, Forex trading is a global decentralized market where you can trade the value of one currency versus the value of another currency. For instance, let's say the pound sterling versus the US dollar. And the reason why you would trade this market is mainly for speculative purposes. You could also, that accounts for about 90% of the total volume Forex trading. The rest 10% is usually for hedging purposes, such as, well, let's say if a company here in the UK is looking to pay their supplier, and that supplier is based in Europe, obviously in order to pay for the services or for the goods or etc., you have to, well, the company has to go to the Forex market to do the exchange to buy euros, and they obviously automatically pay to their supplier. Okay, so that would be the only reason why, like, the company will hedge. But the rest, like many of us, we trade on this market just for, trying to probably make some money out of that. Okay. It's also one of the advantages of Forex trading is that it's the largest and also the most liquid financial market in the world, with a total of, I think it's about now $6.6 trillion of daily volumes. And just to give you an idea of how big this market is, you probably heard a lot about the stock market, particularly in New York. Well, the Forex market is about 15 times the size of the daily trading volumes of not just the New York stock market, but also all the world's stock markets combined. So yeah, this is a quite pretty big market. And also, well, like I mentioned to you before, it's very liquid. So usually that has a big advantage, especially if, let's say, for example, if you're looking to trade a big position, let's say of Apple, it might take you a little bit a while to buy that position, right? And it will not be instantaneously. It might take you sometimes a few hours, or if not days. In the case if you are looking to open, like, let's say, similar size of position in the Forex market, you will have that position open very quickly compared to the stock market. Okay, so that's one of the major advantages as well. Also, what the market is open, the Forex market is open 24 hours a day, 5 days a week. And this is something that I will give a lot of attention, especially for those of you who are just just new to trading. And it's very important to know when the market opens and also when it closes, but particularly when it opens, because there's a lot going on, especially during the weekend, that obviously will affect them once the market opens. So the way the forex market works with the trading hour is if it starts with the Asian market, when pretty much when Tokyo and Sydney opens. So that is usually 10 p.m. London time or 5 p.m. New York time, and that is when the market opens. So once, obviously, with the Asian session, most of these sessions focus on the Japanese yen currency pairs, since yeah, sorry about that. Since well, obviously, all the impact and importance that the Japanese market has, especially with the data and report that has on the market. So let's say, for example, if you have any exposure to, let's say, any of these markets, such as the Japanese yen or the Australian dollar or even the New Zealand dollar, you should really look out for any information or any data release coming out of any of these countries. So let's say, for example, with the Japanese market, if you have any exposure to the Japanese yen, you should watch closely, for example, the Bank of Japan, as well as any information coming out of the Minister of Finance in Japan. Because, well, particularly with the, any information regarding to exports and imports, as well as manufacturing, since, well, Japan is a highly export-oriented country. So all this information, whether positive or negative, and obviously if something like is unexpected for the market, it will have a great impact on the yen, okay? So the same will happen, for example, if you have any exposure or any positions with the Aussie dollar. You should also look out for any data released from the RBA, which is the Reserve Bank of Australia, which is, well, the Australian Central Bank, right? So any information or any speeches about the monetary policies, as well as any changes in the interest rates, will also have an impact on the Aussie dollars. And the same will apply for the New Zealand dollar as well. Any information coming out from their RBNZ, which is the Reserve Bank of New Zealand, will also have an impact of all the New Zealand dollars currency pairs. So that's what happen usually during the evening in Europe, and then in the morning when the Asian session is about to close, pretty much the way it will happen will kind of like close and open up simultaneously when it's well, early morning in London, or in this case in Europe. Again, with the European session, you should really keep a close look of any events, right, that will happen during the day and also throughout the week regarding to the European session. The main reason for this is because, well, it's pretty much the main trading session. It happens during these hours. One of the main reasons is because, well, as you've probably seen, the European session overlaps with the end of Asian session and also with half of the American session. Okay, so it's very important as well here with the with Europe to keep an eye of any data release that might come, especially from the European Central Bank. That usually is enough, but also you should also be aware of any data coming out of Germany and also France, since well, these countries are the largest country in the Union. And also, and ultimately, it will have a great impact on the euro. Okay, so especially if it's unexpected, any data, especially with, for example, with Germany, right? Any data related to manufacturing will have a great impact on the euro, as well as, well, nowadays with all the situation happening with the COVID-19 the last 12 months, obviously GDP data will also be closely looked at from all the, well, from all the traders out there, and also for the markets. And the same will happen with France. Any economic data, also including the GDP as well, will be closely looked at. And finally, also with the European Central Bank, I want to highlight a little bit more about this, simply because, well, it has a great impact on the euro. And as you probably see or read in the financial news, the importance of the European Central Bank speeches. That is usually, well, the speech comes from the president of the ECB, which is in this case, well, Christine Lagarde. And usually the speeches are based on the economy outlook for the European Union, and particularly with the interest rate. Okay, so let's say, for example, this Thursday, the markets are expecting and looking also to see what the European Central Bank decision is going to be. Usually, for example, this Thursday, they will announce the deposit facility rate for March, which is where banks might use to make overnight deposits with the Euro system. As well, this Thursday, they will also be announcing the marginal lending facility rate, which offers overnight credit to banks from the Euro system, and of course the interest rate, right, which has been so significant to keep the European economy afloat during this COVID situation that we have been in the last 12 months. So obviously, usually this happens around 12:30 p.m. London time. So you have any exposure to the euro, you should keep an eye on this, okay? If you're planning building your own trading strategy, also be aware that any information that might be unexpected or very significant for the market, it will move the price of the euro. So yeah, you don't want to be caught out on this. Say, for example, you were noting from your screen at the time, and you didn't have any of the orders, which I will explain to you later on. And then, it might happen if the market goes against you, you might blow out all your accounts, right? So you don't want that to happen. So be careful with all this. Also, there's plenty of financial websites that offer the economic calendar. So it's always good for you, especially before the week starts. You have to have a quick look at what events are happening for that week ahead. And well, just make sure that you are aware of that, and you make your trading plan accordingly. And then finally, well, with the American session, this is well, similar to the other two previous sessions. You should keep an eye on the U.S. economic and data reports that come out throughout the New York session. Essentially, we're similar to the European Central Bank there in America with the Fed speeches, or the FOMC meetings, which is the Federal Open Market Committee, whose members are obviously responsible for the monetary policy in the US. So again, if you have any exposure to the US dollar, you should keep an eye on any information coming out of these committees, and also the Fed speech that usually happens on a Wednesday. Wednesday, 7 p.m. normally, that is the time, 7 p.m. London time. So you should, again, be aware of this and make your trading plans available. And well, also, yes, I would like to also highlight one thing about the the American session, okay? If you have any exposure to stocks in the US, especially during the earnings seasons, most of the companies report their earnings outside, well, after close hours, okay? So that would be usually after 9 p.m. London time. So obviously the market's already closed with that when they release this data. So obviously, if there is any significant impact of this, it will be reflected obviously in the post-market, but usually in the once the market opens again the following day. So yeah, there's a few things, points I wanted to mention to you guys to keep an eye, especially if you are new to trading, because they are very fundamental for your success in trading. Okay, now let's move on into how to read or how to trade currency pairs. So the first thing that you guys should look at is the base currency, okay? That is pretty much the main thing you should look. So here, for example, in this example, you can see the pound sterling versus the US dollar. And the reason why the base currency is very important is because this is where the trade, the position that you're gonna be either buying or selling, or the position you're gonna be opening, is the currency where the position will be denominated by, okay? So if you are looking to trade one full contract of pound sterling versus US dollar, that will be 100,000 pounds. It will not be in dollars, okay? So obviously, memorize this, because later, maybe in about 5 minutes, when I explain to you all the basic about how to trade Forex, you might get confused because you will have 3 different type of currency denominations. So this is the main one. Always keep an eye on the base currency when you're gonna be opening any currency position, okay? Now, this is the table of the contract sizes. You have pretty much 3 sizes of contract. The first one is called a standard contract, or a standard lot, we usually call it. For the currencies, it will be 100,000 units, or in other words, it would be 100,000, and the currency denomination will be based on the base currency I just mentioned to you before. So in the case of my previous example of the pound sterling versus the US dollar, the standard contract would be 100,000 pounds. Then you have the mini contract, or the mini lot, which is 10,000 units. And the smallest contract, which is a micro contract or micro lot, which is 1,000 units. And that is across all the currency pairs. Then for the gold, as you can see, would be slightly different. For the standard contract or lot, it would be 100 ounces. For the mini contract, would be 10, and for the micro contract, would be 1 ounce. For the silvers, again, slightly different, would be 5,000 ounces for the standard contract. For the mini contract, would be 500, and for the micro contract, would be 50 ounces. Well, for the oil, as you can see, 1,000 barrels. For the standard contract, 100 barrels for the mini contract, and 10 barrels for the micro contract. So here again, guys, if you didn't know this before, very, very important that you memorize this contract sizes, because they're pretty much fundamental for opening any position. And also, you don't want to be, I know it could be confusing in the beginning, but it's very important that you memorize this, because obviously once you go to the platform, you might not be able to see this. Essentially with the MT5 platform, where if you want to know a bit more about how to trade on the MT5, tomorrow we actually have a webinar at the same time, 6 p.m. London time, where we'll be showing you how to trade CFDs on the MT5. So if you want to know a bit more about it, just please, after the webinar, you can go to our website, cfifinancial.com, and under our webinar section, you can sign up for that webinar tomorrow. So yes, so this is the contract sizes, but now you're probably wondering, well, what is the value of, once you open a position, how much money you're going to be making or losing? It could happen in most of the cases. And that is what we call a PIP, okay, which is, it is the smallest increment in price fluctuation, usually currency prices. It's also 0.01%. And it's the 4th decimal of the price. So here you can see an example of, let's say, with the same example I gave you before, with the pound sterling versus the US dollar. So let's say 1 pound is 1 spot $38.12. As you can see with the number 2, that is what a pip is. So obviously, every time you see that number either going up or down, that's a pip. And usually the value of a pip, it will vary, okay? And it will depend on the contract sizes. So for all the standard contracts, the value of the pip it will be $10 per pip. In the case of currencies, gold and oil as well. For the mini contract, it will be $1. And same for currency, gold and oil. And for the micro contract, it would be 10 cents per pip. And obviously, as you can see here with the silver, it would be slightly different. For the standard contract, it would be $50 per pip. Mini contract would be $5. And for this micro contract would be 50 pip. Also, guys, just please bear in mind here that with the pip value, it is always or will always be denominated in US dollars, regardless of what currency pair you're trading or your account currency. Okay, so with the previous example I gave you, let's keep with the same one, the pound sterling versus the US dollar. Obviously, when you open the position, the standard contract would be 100,000 pounds, but the pip value will be $10, okay? So remember when I mentioned to you earlier that you might have 3 different currency denominations? Well, that's exactly what I meant. The contract size if you're trading pound sterling versus US dollar would be 100,000 pounds, but then the value of the pip would be $10 in this case. And then let's say, for example, that you are trading account currency is in euros, then suddenly you have 3 different currencies just for one trade, okay? So obviously, don't need to worry too much about this in the way that obviously the platform will calculate all this automatically. But it's important to you to know this, because if you are doing your trading strategy, or let's say, for example, you are testing your strategy on a demo account, you should know that, well, obviously the value of the pip, right? Especially if you later at the end of this webinar, we explain to you the one of the type of orders that will protect you from losing more money. And you have to put it, depends on how many pips from the current price, whether it's 10 pips, 20 pips, or 100 pips. Obviously, that would be either $100 or $1,000, right? So again, very important that you memorize this, since obviously it's fundamental for your for trading Forex and also, well, CFDs overall, okay? And here's just to give you an example. So let's say the price of the pound sterling versus the US dollar at the moment is 1.3812. And you're trading the standard contract, right? The 100,000 pounds. And then let's say that that price goes up by 1 pip. You're trading the standard contract, then you will have made $10, okay, on that trade. And then obviously, if you have gone short, you have been losing $10. And then obviously, if you were trading the mini contract, that would have been $1, and also for the micro contract would have been 10 cents of a dollar. Okay, so yeah, it's very important you know this. Obviously, if you have any questions about this, or maybe this is a little bit confusing, it's not a problem. You can always contact us, and we can explain this to you in more details as well if you would like to, even myself as well. Here in London, so you contact our London office and ask for me. I'm more than happy to help you with any questions or something that you don't understand about trading Forex or even CFDs overall, okay? Now, the other point well, it's basically what is a spread, right? This is important because it's part of your trading cost. And when you see in the platform, you will have 2 prices. One is the bid price, which represents the price at which the broker is willing to buy. And in the case of, from the trader point of view, selling. And the ask price, which represents the price at which the broker is willing to sell. And here's how it will look in the platform. So as you can see here, you have 2 prices. And also the platform in this view will give you the spread between the sell and buy prices. As you can see here, there's something that you have to, I want you to, well, you should bear in mind that you can see here the spread of the pound sterling versus the US dollar is 20 points, okay? That is not the pip, so it would be in this case, it's usually 1 0 to the left, so that would be 2 pips, the spread. So the cost of to trade, let's say you go long on the pound sterling, one standard contract, it will be $2. Okay. Again, the spread will always be denominated in US dollars. Okay, regardless of the currency you're trading or your account, your trading account currency. So yeah, so that's how it will look in the platform. You will have two prices, and whether you're selling or buying. And you should always look for the fourth decimal, which is the pip, right? And then obviously the fifth decimal you can see here in a very small number, that's a fraction of a pip, but usually the main focus is on the pip, okay? And this is essentially what is the spread, is the difference between the buy and sell prices, okay? Now, also guys, if you're gonna be holding your position overnight, that, let's say, for example, you today, right now, 6:30 p.m., you open a position of the pound sterling versus the US dollar, any position, whether it's the standard contract, the mini, or the micro contract, and I decide to hold that position until tomorrow, you will normally get charged an interest, okay? And that's what we call swap rate or rollover. It's essentially an interest that you earn or pay by holding a CFD position overnight. Usually it's 10 p.m. London time. So whether you pay, you earn, which depends on whether you're going long or you're going short on the currency positions. But if you are gonna be trading either any indices, commodities, equities, you will have to pay regardless of whether you go long or short, okay? And that happens normally. Obviously, there is a different situation for every individual, but normally speaking with CFDs, you have to pay a swap rate, especially if your account is held in here in the UK, for example. And then also if you hold, let's say, for example, that you hold that position on a Wednesday night, you will get charged 3 times. And that is simply because the weekend rollover. So Friday, Saturday, and Sunday. And of course, if you close your position, let's say on Friday, you will get charged once. But yeah, it's very important also to know this in case, because it happens sometimes that clients, especially you're new to trading, and you kind of forget about this, and then also the next day, when you see your trading history, you see an extra charge, and that is what's actually what it is, right? The swap rate. Okay, now, and well, basically the final session of this webinar is with the type of orders. Before we move into the type of orders that are available for trading, guys, let's first tell you a little bit more about what is an order and how it can help you for your trading, okay? So basically, an order is pretty much an offer that you send to your broker, obviously through the platform voice broking, in the case if your broker provide that service, to open or close a trade. And as I mentioned to you before with the trading Forex, the market is open 24 hours a day, right? Which means that the market movements will still happen while you while you sleep, or let's say, for example, you go to the toilet, or if you're not a full-time trader, you are, for example, at work, which obviously, in case if you're working, you require your full attention, or well, at least that's what you hope, your boss hopes for. But obviously, while you're not at the desk or looking at your platform 24 hours, the market will still happen, right? Will still be moving. And therefore, this is where an order will help you to act in the market while you're basically not there, okay? So they can help you by implementing a trade strategy from entry to exit, by limiting any risk in volatile or uncertain markets, and also to take profit and minimize your losses, which obviously is essential for your trading survival as well. So now let's move on with the type of orders. So we have type of orders. So the main one is, the first one is market order, which is essentially an order to be executed at current market price. And then you have the second type of order. Well, here's an example before I'll move with the second type of order. This is how we look in the platform, okay? So here As you can see with the pound sterling versus US dollar, you select your type, which is market execution, use one standard lot, and then you simply either sell or buy at the current market price, which is shown there, as you can see. The second type of order is a pending order. Here is, well, pending order is an order to be executed at a later time at a specific price. And you have three types of pending orders. One is a limit order. Then you have a stop entry order. And the final one is the stop loss order. And here with, well, with the limit order, you have two types of limit order. One is a buy limit order, where the price must be entered below the current market price. So let's say, for example, here you can see with this little diagram, let's say that at the moment, the price of, let's take the same example with the Dow Jones, is at the moment $100. But then you believe that the market will continue, let's say if it's downtrend situation at the moment, you believe that it will continue to go this direction. But then after reaching certain price, let's say $90, you believe that the market will reverse and then will go up. So what you could do then, you simply place your buy limit order at $90. And once the market reaches that price, your position then will come available or will get opened in the market, and then you have then your open position. And obviously, you hope, obviously, once that happens, the market will reverse and you will will have the profitable position. On the other hand, obviously, if you are looking to go short, you can simply buy your sell. You can place your sell limit order, where obviously the price must be entered above the current market price. As you can see here, it's the same situation. You believe that there's an uptrend movement at the moment, and then after reaching a certain price, let's say if the current price is $100, after reaching, let's say $120, and the market will reverse and then will go down, and then you put your sell limit order at 120 or 125, whatever you would like. And once you reach that price, then the order will become available. Okay, now with the second type of pending order, we have the stop entry order, which obviously this is when an order basically stops after the market price reaches the stop price that you selected. And the way the stop entry order works is basically you place an order about the market price. And if you believe that the market will continue to go in that direction, okay? So here, one of the types, you have two types of stop entry order. One is, as you can see here, buy stop order, in where you put the order above the current market price. And so let's say, again, same example with the Dow Jones at $100. If you believe that after the market reaching, let's say, $110, the market will continue to that direction. Instead of just waiting to see if that happens, you can simply put this type of order at 110. And once the market reaches that price, it will become available at the best price available. Obviously, something that I should have said before, these pending orders are not guaranteed, okay? So it's just once the market reaches to that particular price, it then become available, whatever the best price is at the moment, okay? Sometimes it could be 110 in this case, but sometimes it could be 115. So yeah, so this is what would you put a buy stop order. You believe that the market will continue to that direction. And also the same will happen if you want to go short. Just simply place your sell stop order below the current market price if you believe that after reaching a certain price, the market will carry on towards that direction. Okay, and now we're going to, well, the last of the pending order, which is stop loss order. Here, well, with the stop loss order, I know it doesn't really sound very good, but it's usually very critical for your trading survival, okay? And simply is because it stops your losses by basically closing out an existing position when the market is going against you, okay? And the way it works is, for example, if you go long, and let's say you believe the price of, let's say again, same sample, the Dow Jones will go up, but obviously there's always that risk that the market might just go against you, and if you don't want to have that exposure to be, you know, like I mentioned to you earlier before, that you can lose all your money if the market goes against you and you don't close out your position. What you could do then is to protect that position. You simply put your buy stop at, let's say, it depends of your risk management and how much money you are willing to lose for that particular position. You can put about 10 pips or 20 pips or even 100 pips from the current market price. So let's say, for example, if the current market price is at $100, you place your order and then you put the buy stop at, let's say, well, let's say I'm willing to lose $10 in here. So then you put your your buy stop at $90. Again, it's no guarantee, but then what will happen that once the market reaches to that price, it will get stopped at the best price available, okay? Obviously, when there is a normal condition, usually it gets stopped at that price that you set up previously. But then if there is a low volatility in the market, well, obviously the price can go from 100 to 50 in one go too, right? So then the price, next price would be then at 50. So yeah, always bear this in mind when you placing your stop orders. And then, well, again, the same will happen if you wanna go short. You just place your sell stop above the current market price, similar than before. How much are you willing to lose? Or how much are you willing to risk, I should say, sorry. For that particular position, you set up your sell stop at either, you know, 5 few pips or even more, okay? Depends of your risk management. And then with the last one of the pending orders would be, well, the trailing stop, okay? Usually with the trailing stop, I don't know if you, well, probably some of you might have about this one, but one of the keys to successful trading is to cut losing position quickly and let your winning position run. Well, that is essentially what a trailing stop is, okay? It is a stop loss order that you set at the fixed number of pips from your entry rate. And let me give you here an example how a trailing stop works. So as you can see here with the this example, the pound sterling versus the US dollar. Let's say that you are gonna put the current price is at, as you can see here, one spot of 39,937. Then you want to put your stop loss, let's say 100 pips from that particular price. So then you set up your trailing stop at one stop 39, in this case 837. If the market will continue to go up, let's say this is a long position, and the market continues to go up, that stop order or that trailing stop will continue to move 100 pips from the next price, okay? So let's say if the market goes up by 10 pips, so in this case would be one stop 39,947, then your trailing stop would then move another 10 pip as well, okay? And this will continue to happen as long as the market goes in your favor. Obviously, if the market goes against you, it will get stopped. Your position will get closed out once it reaches the price. You can see here with the one spot 39,837. Okay, so well, this is essentially what the type of orders that are available to trade CFDs, which are, like I said to you before, guys, it's very fundamental that you understand this and you know how to apply them. Because it will help you with your trading, essentially. If you know, the last thing you want is to have your position open and don't have any protection. Then, you know, there is a lot of volatility in the market, and then you step out of your screen for a few minutes. When you come back, you didn't have any of these type of orders that might protect you, especially with the stop loss. You will then obviously might find your account even lost all the position and all your money, okay, which something you don't want to do. So, okay, so with this, we pretty much covered all the fundamental of online trading. And now, for those of you who are not a client of CFI, I'm just gonna quickly explain to you what we are and what we do. Obviously, you probably know already, we are a Forex broker. And we were first established in 2005. And since then, we basically were expanding worldwide. And now we currently have 6 offices worldwide. We have one in Lebanon. We also have obviously the one here in London, the United Kingdom. We also have the main one in Dubai, as well as well, we have the office in Jordan, Mauritius, and also in Cyprus. And of course, we are regulated brokers too. So we have the FCA regulation. We also have the license under the Lebanese Financial Authority, the Bank du Liban. We also have the DFSA, the Dubai Financial Services Authority, the same for Jordan. We also have the one for CISEC as well, and the one for Mauritius. So this is obviously essential for you. And then also, guys, those of you who are already clients or would like to be a client of CFI, just bear in mind, if you are, let's say, outside Europe, if your account is going to be held in the UK, or it may also be if you are based in the Middle East, each account is going to be under the Dubai regulation, because like I mentioned to you before, you will have a different client protection, and also the leverage will be different based on your of the regulation, right? So like I said to you before, with here in the UK, you're going to be trading Forex products. Your leverage, and if you are a retail client, your leverage would be up to 30-1 for the major currency pairs. For the minor currency pairs, it would be up to 1-20. And in the case of, for example, in Dubai, it will be different. It will be up to 50-1, I believe. Okay, so obviously this is something that you should also consider, not just with CFI, but with any other broker that you are going to be trading with, to look at what is the regulation, what are the client protections. Okay. Also with CFI, you can trade not just CFDs, but also futures and options, and pretty much everything in equities, Forex, commodities, metals, bonds, and also oil. And well, here with CFI UK, you have a leverage up to 30-1, like I mentioned to you before. If you are a retail client, if you qualify as a professional client, we are able to give you up to 400-1. Obviously, the spread, it could be as low as 0.0 pips. Depending on the type of account, we have 2 types of accounts here in the UK. So if you get the premium one, or you qualify for the premium one, you might get the spread as low as 0 pips. Also with the execution, we offer fast, ultra fast execution, deep liquidity as well, and also, well, another important aspect is our custom service, which are available 24 hours a day, 5 days a week. So with that, guys, I conclude this webinar. I hope you enjoy it. And if you have any questions, please feel free to ask them in the comment box, okay? Okay, seems that everything seems to be clear, since there is no questions at all. So, well, guys, I hope you enjoyed tonight and have a lovely evening. Until next time, goodbye.